Hello everyone, this is Carbonomics. The topic of today's video is actually the basis for my channel's name, the economic opportunity behind the world trying to tackle global carbon emissions and meet climate goals. There will be plenty of companies and sectors to invest in that will contribute to a greener future, but most will not have the same level of upside that the carbon credit space does. The valuation of the voluntary carbon markets is set to 15x by 2030, and that is on the low end of estimates by analysts in the sector. While EV stocks, hydrogen names, renewable companies have been overvalued or at least were before the recent downturn, carbon credit royalty companies are losing so much value in market cap that they're actually approaching cash levels. Meanwhile, royalty companies provide solid cash flow and lower risk in typically volatile commodity markets. But let me lay out why this is such a large opportunity in carbon credits. Why is the market so undervalued? There are two sections of the carbon credit markets, and I will address them both. There are the compliance markets, which are the markets where participants are obligated to reduce emissions by the government, and voluntary markets, where buyers are choosing to offset emissions on their own. While both markets have upside over the coming decade, I believe that the voluntary markets will provide the best returns for us as individual investors. It's in my opinion. So I will elaborate further on voluntary markets first. As far as the markets are designed, voluntary markets allow for individual companies to provide supply, as compliance markets have carbon allowances that are given out by the government in comparison. In all commodity markets, these companies have leverage to the price of the underlying commodity, meaning they will provide better returns than the commodity itself if its value rises. This is because the cash flows are multiplied as the cost of capital expenditure remain relatively the same for the company. So a carbon credit royalty company can go up multiples in value more than the value of carbon credits themselves. Ultimately, while compliance markets have a temporary advantage due to demand being forced to come into the market, I tend to hold distrust of the government being reliable in any investing scenario. After speculating in mining stocks for years, I've realized that relying on the government for any investment thesis is 9 times out of 10 going to set yourself up for disaster. Now, why do I say that compliance markets have a temporary advantage? We will see voluntary markets become increasingly less voluntary as debt covenants change due to the green bond market that I have mentioned previously in the last carbon news segment. As climate goals close in, financial institutions and investment funds are shifting their requirements for funding or investment. A company will be forced to reduce emissions because if they do not, a competitor will. That competitor will receive that funding and potentially lower debt requirements, leading to a significant advantage. And this is why the voluntary markets are going to become more of a necessity for public companies than anything else. Now, as this shift takes place over the next 5 to 10 years, carbon offsets will become a requirement for many companies. This will pad demand and certainly reduce cyclicality in comparison to typical commodities that we see in the broader market. We may even see cyclicality taken out of the space for the most part, as companies are forced to offset emissions to meet their climate objectives. And ESG narratives growing stronger only puts more pressure on companies to make significant changes. And pressure from financial institutions, climate scientists, government officials, and even more sources will bring climate risk to the forefront of a management team's priorities in the future. The SEC, looking to enforce climate disclosures, continues to remind investors and these public companies about their ESG goals as well. As demand will continue to rise, some analysts studying the carbon credit space refer to them as genuine giffen goods. And this means when the price of a commodity increases, the demand will only increase in turn, where most commodities would typically operate in the exact opposite way. Now, the narrative that carbon capture is going to make carbon credits obsolete will not come to fruition for decades, if ever, in my opinion. Most forms of carbon capture are currently expensive, and as the current technology stands, there isn't much potential there for at least some time. Now, here's a picture of items made with petroleum products. We have electronics, phones, headphones, makeup products, medicine, toys, musical instruments. Many of the processes used to make these products could possibly never reduce all of the emissions involved entirely. And this is why carbon credits make for such a great investment in a world desperate to reduce CO2 emissions. And as for carbon credit supply, that doesn't suddenly come online either. There are limited possibilities for projects, especially because of stringent requirements that verification nonprofits like Vera and Gold Standard use to ensure that new credits are issued legitimately, right? For example, a product developer has to prove that the land they are preserving to create these carbon credits was going to essentially be destroyed without the funding from carbon markets. You can't just go and start producing credits from trees in your backyard in the middle of a suburban city. And additionally, credits tend to take a few years to be generated out of a new project as it is. Similarly to other commodities, supply cannot respond immediately to a rapid increase in demand, which is going to rise dramatically the closer we move to the targets many companies and countries have set for themselves by 2030. While this is not investment advice, this is all for entertainment value. It is a good idea to focus on companies that offer a well-diversified portfolio of credit-generating projects. And this is especially important due to the jurisdiction many of these carbon offset projects are located in. There's South America, Africa, and Southeast Asia hold a significant portion of the large projects protecting large swaths of nature. These areas host politically risky countries with ongoing conflict and shifting regulations. We've seen this in Colombia as well recently with the election of their new president. This happened to Carbon Streaming Corp themselves, also known as NETS, when Indonesia could not determine a clear carbon market policy, and this subsequently led to the suspension of the issuance of credits to NETS' largest project, Rimba Raya. The voluntary carbon markets are certainly still forming and changing shape, but in my opinion, taking positions early will lead to incredible gains. Now, the compliance markets could provide great returns as well, but many of those markets are more developed than the voluntary markets currently. The EU ETS, which is the European Union's emissions trading scheme, was valued at $850 billion last year. It really depends on the potential size due to the possible market participants, right? California and a few provinces in Canada in their emissions scheme will never hold the same economic value as the entirety of the EU. However, price appreciation is naturally built into these markets, as there is an annual reduction in the amount of allowances given out to those market participants. Add that onto the creation of a market stability reserve in 2019 to help deal with the allowance surplus in the European markets, and there's definitely room for some moderate gains from here. Although government officials are currently voting on whether to sell $20 billion worth of allowances from the reserve, so that's definitely something to watch out for. It is important to focus on fossil fuel usage within the European Union as well, and all carbon markets really, as this significantly impacts the direction of the allowance pricing. As coal usage has been rising in Germany and other areas within the EU, the price of EUAs, European Union allowances, have been moving up in kind. The more fossil fuel usage and the more dirty a fuel is, the more allowances need to be used by the electric utilities. But how I personally view the compliance markets is either as more of a hedge against ESG policies negatively impacting some of the companies I invest in, or as a relatively short-term trade if one of the market's allowances are deeply oversold. So in compliance markets, it's definitely easier to see how you will get a positive return on your investment, but the gains will likely be lower than what is found in the voluntary space, in my opinion. So one of the trades I made on the EUAs myself actually occurred in late February when there was a massive sell-off in the European compliance markets due to the Russian invasion of Ukraine. And there's some opportunities you're going to see like this from time to time. So this is kind of what I'm talking about when I'm talking about the shorter term trades. And that was forced by the Russians selling foreign assets by the Russian government. They were essentially forced to sell out of all foreign assets at the time. So, given the level of uncertainty and then Russia, subsequently being forced out of Western banking systems in many ways, that was definitely an opportunity there. And I managed to buy near the bottom of this sharp decline, due to the information from Lawson Steele, who is definitely a great follow if you don't already follow him on Twitter or LinkedIn. And I will link his information below for those of you interested in some of his coverage of the European markets. So that wraps it up for the investment thesis on carbon credits. If you enjoyed the video, please don't forget to like, comment, and subscribe. Thanks, guys.